Hi friends, so today we are going to understand what is the balance sheet of a company. We are going to understand what are the contents within the balance sheet and what each content actually represents within the balance sheet. So if we hear the word balance, typically we understand that in order to have balance there need to be two parts. So these two parts of the company, the first part of the company is what is called as the assets of the company, and the second part of the company is what is called as the equity plus liabilities. So the asset is what the company owns and the equity plus liability is what a company owes. To whom does it owe, by the way? Equity is what the company owes to its stakeholders, to its promoters as well as shareholders. And liability is what the company owes to the banks and institutions in terms of loans, whatever it has secured for itself. Assets. Now finally, these assets are created because of the funds it is able to raise from equity and liabilities. So now let us understand why equity is part of the liability part of the whole equation. Now equity, in other words, is also called as the net worth of the company. So if we have to derive the net worth of the company, what we need to do is from the assets, from the total assets whatever the company has, we need to subtract the liabilities that will give us the net worth of the company. So the whole equation of liability then moves on the equity side. So this is the way it is represented in the balance sheet. The balance sheet would first have the asset section and then it would have the total equity plus liabilities. So let us see what is comprised within the assets, what is comprised within the equity as well as the liabilities. So within the asset, there are two segregations. The first part is the non-current asset and the second part is the current asset. So when you say non-current, it is typically long-term in nature. So these are the assets that the company uses for a period of more than a year. So these assets create value to the company for more than one year. And when you talk about current assets, these are the assets which the company expects to dispose within a period of 1 year. So now let us see what are the types of assets within non-current or current assets. So we would find mainly tangible assets which are physical in nature. Then we will find intangible assets and we will also find investments which the company made. These are also classified as assets. It could be long-term or short-term. We will see into that matter. And then we would also have something called as a trade receivable. Trade receivables is always part of the non-current assets. Anyway, let us see each of these one by one. When we talk about tangible assets, what comes in our mind is the physical nature of the assets. So hence it would be plants, property, equipment, computer equipment, whatever the company needs so that it can manufacture its goods and sell in the market. Now when we talk about intangible assets, these are non-physical in nature. So these are trademarks or copyright, certain arts and songs which the company uses to sell its products into the market. It creates a consumer mindset so that the consumer is able to buy its products. So these are part of the intangible assets. Now when we say about investments, investment is certain profits which the company would have earned or certain funds which the company would have earned for which it decides to invest into certain marketable securities, or it could also be that it wants to give loans to its employees or any third party or internal corporate matter. So when it gives such investment, it's able to earn income for itself. So this investment, if it is for a long duration of time, more than a year, so those will be classified as non-current assets. And if these investments are closing to expiry, that means they are going to wind up within a period of 12 months, then such kind of investment will be classified as current assets. So now the last topic within the asset part, that is the trade receivables. So trade receivable is classified most of the times into current assets. So this is what the company is expecting from its retailers as cash back to itself. The company out of goodwill or out of certain promissory notes, it would have issued products to its retailers on expectation that they would pay back at a point of time. So these trade receivables, whatever cash the company is expecting in future, those are classified as trade receivables. And it is always part of the current asset. In few cases, it might come into non-current asset if it is expecting the payment for more than a year. So there could be cases, but I have not seen such cases in whatever annual reports I have analyzed so far. So now let us look into the equity section of the balance sheet. When we say equity, there are two parts of the equity. The first is the owner's equity. So this is what the owner's authorized capital is converted into paid up capital or subscribed capital, wherein the public also gets involved. So this is one part of the capital for which the company is able to raise funds for itself, is the share capital. The second part is the reserves and surplus. So what is reserves and surplus? As you know, every year the company earns profit for itself. So as and when the profit is earned, the retained earnings of the profit is what is carried into the reserves and surplus. So this is what reserves and surplus is. So next, let us see into the liability section. So liability, as we also saw in the assets, liability also has two segregation. One is the non-current liabilities and other is the current liabilities. So non-current liabilities, like the way we have seen in asset, non-current liability is also those liability for which the company has taken for a period of more than a year. And current liabilities is what the company expects to wind up within a period of a year itself. So now what would comprise within liabilities? So liabilities would involve like certain lease premises which the company might have taken. So that becomes a liability for itself. It becomes an asset to the party who is giving that particular premise on lease to the company. So there would be lease premises, and these lease premises could be either non-current or current. If it is going to be winded up within a period of a year itself, then it would be classified as current liabilities. And if it is going to be taking more than a year, then it would be classified as non-current liabilities. So now this is lease premises. This is part of the property aspect. The second could also be loans which the company has taken from banks. So this will also be classified as current or non-current liabilities depending upon the tenure of the loan remaining for the company. If the tenure is more than a year, then it will be classified as non-current liabilities, and if the tenure is less than a year, then it will be classified as current liabilities. So now what else is comprised within the liabilities? So the third aspect within the liabilities is what is called as the provisions. So provision is what the company keeps like a contingency. Capital is kept for gratuity of the employees, certain compensated absences of the employees, certain provident funds which is expected to pay either after a period of a year, then it would be provisions under non-current liabilities. And if it is expected to pay the provident fund within a period of a year, then it will be classified as current liabilities. And the last part within the liabilities is something called as the trade payables. So trade payables is what the company has received from its suppliers. It would receive raw materials from its suppliers for which it is expected to pay back its suppliers. So this capital what the company is expected to pay back its suppliers, that is classified as under trade payables. And usually trade payables is also part of the current liabilities. And there are other aspects like deferred tax, which could be part of an asset or it could also be part of the liabilities. In case the company has paid more in the previous years, then the tax part would be classified as an asset for itself. If the company has paid less in the previous year, then it would be considered as a liability to the company, which the company has to pay in the subsequent year. So this is about the balance sheet. What we have understood in this particular session is what is comprised within the balance sheet. As we have seen, equity is called as the net worth of the company, asset is what the company owns, and liability is what the company owes to banks and institutions. So the net worth is what the company owes to its shareholders. That means whatever reserves and surpluses it has retained over a period of years, and the share capital it owing back to its promoters as well as the shareholders of the company. I have also realized that balance sheet could also represent our own financial status. In our own personal lives as well, we could draw this balance sheet. We as well have something called as an asset, and we also have something called as the liabilities. If our assets turn out to be more than the liabilities, then we have a net worth. If the liabilities turn out to be more than the asset, then our net worth is nothing in fact, right? It would be negative net worth. So this is how you can look into your own personal balance sheet as well. It's really fun. It's really good to to do your personal finances as well. Plot it down on a balance sheet. So that was it in today's session. So looking forward to you in the next videos. So please subscribe so that you can gain from all the subsequent videos as well. See you.